Let me ask you something. When was the last time you saw a metal that's absolutely critical to modern civilization trading below its cost of production? I'm talking about a commodity so essential that without it, your smartphone wouldn't work, solar panels couldn't exist, and electric vehicles would be impossible to manufacture. Yet right now, this metal is being sold at prices that make zero economic sense. Silver is trading in a zone where major mining operations are losing money on every ounce they pull from the ground. Think about that for a second. The very companies responsible for supplying the world with this critical resource are operating at a loss. What happens when they can't afford to keep the lights on? But here's where it gets really interesting. While miners are bleeding cash, industrial demand is absolutely exploding. We're not talking about a modest uptick. Global silver demand has created 5 consecutive years of structural deficits. That means, for 5 straight years, the world has consumed more silver than it produced. The gap? It's being filled by above-ground stockpiles that are rapidly depleting. The Silver Institute just released data showing something remarkable. Industrial fabrication demand remains near record levels despite economic headwinds. Why? Because there's no substitute for silver in most of its critical applications. You can't build the green energy infrastructure governments are mandating without massive amounts of silver. Each solar panel requires about 20 grams of silver. Electric vehicles use up to 55 grams per vehicle, compared to just 15-28 grams in traditional cars. Now, multiply those numbers by the millions of solar panels and EVs being manufactured globally. China alone installed over 200 gigawatts of solar capacity recently. Do the math on how many ounces of silver that consumed. It's staggering. But let's talk about what's really happening beneath the surface. The paper silver market, the futures contracts traded on the COMEX, represents claims on silver that's roughly 100 times larger than the physical silver actually available for delivery. It's a fractional reserve system for precious metals. As long as everyone's content trading paper contracts back and forth, the system works. But what happens when people start asking for actual metal? We've already seen glimpses of this. In early 2021, retail investors coordinated a buying campaign that nearly broke the physical silver market. Premiums on physical silver coins and bars exploded to 50% or more above spot price. Dealers ran out of inventory. Mints couldn't keep up with demand. And that was just retail buyers. Imagine what happens when institutional money decides it wants physical exposure. Here's something most people don't realize. Central banks aren't just buying gold. They're quietly accumulating silver too, though they don't publicize it the way they do gold purchases. Why would they? If you're a central bank looking to diversify away from dollar-denominated assets, silver offers something gold doesn't: industrial utility combined with monetary properties. It's insurance that also has fundamental demand drivers. Let me paint you a picture of what's coming. The global push toward electrification isn't slowing down. It's accelerating. Governments have mandated timelines for phasing out internal combustion engines. They've committed to renewable energy targets that require exponentially more solar capacity. The infrastructure bill in the United States alone allocates massive funding for grid modernization and clean energy, all of which requires silver. Meanwhile, primary silver mine production has been essentially flat for years. Most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, and zinc. When those base metal prices are weak, silver production drops because it's not economical to run those operations. We're in a situation where demand is surging while supply is constrained. The deficit has to be made up somehow. Right now, it's coming from above-ground inventories. But those aren't infinite. The COMEX warehouse stocks have been declining. The London Bullion Market Association vaults show similar trends. At some point, the math stops working. You can't consume more than you produce indefinitely without running out. Now, I want to talk about something that doesn't get enough attention: the gold-to-silver ratio. Historically, this ratio has averaged around 15 to 1. That means 15 ounces of silver would buy you 1 ounce of gold. For most of human history, that's roughly where it traded, because that's approximately the ratio at which these metals occur in the Earth's crust. Today, that ratio is hovering around 80 to 1. Silver is historically cheap relative to gold. Some would argue it's the most undervalued asset in the precious metals complex. When this ratio reverts to its historical mean, and it always does eventually, the move in silver will be explosive. We're talking about potential gains that dwarf what gold might do. Let me tell you about what happened in 1980. Silver went from around $5 an ounce to $50 in a matter of months. That's a 10x move. What drove it? A combination of inflation fears, geopolitical instability, and the Hunt brothers attempting to corner the market. We have similar conditions today, minus the market manipulation. Inflation is running hot despite what official numbers claim. Geopolitical tensions are at levels we haven't seen in decades, and the supply-demand fundamentals are far more bullish now than they were then. But here's the thing about silver that makes it different from gold. Gold is primarily a monetary metal. Its value comes from being a store of wealth, a hedge against currency debasement. Silver has that same monetary property, but it also has this massive industrial demand component. That creates a floor under the price. Even if investment demand disappeared tomorrow, industrial users would still need to buy silver at any price to keep their operations running. Think about the semiconductor industry. Silver is used in virtually every electronic device because of its superior electrical conductivity. As we move toward an increasingly digital world, with 5G networks, Internet of Things devices, and artificial intelligence infrastructure, the demand for silver in electronics is only going to grow. These aren't optional purchases. Companies need silver to manufacture their products. The medical industry is another huge consumer. Silver has antimicrobial properties that make it essential for wound dressings, medical equipment, and water purification systems. During the pandemic, demand for silver in medical applications surged. That demand hasn't gone away. If anything, there's heightened awareness of the importance of antimicrobial materials in healthcare settings. Now let's talk about what 10 ounces of silver represents. At current prices, we're talking about an investment of a few $100s. That's accessible to almost anyone. But those 10 ounces represent something more important than their dollar value. They represent a tangible asset that can't be printed, can't be debased, and has intrinsic value based on its utility. When you hold physical silver, you're holding something that's been money for thousands of years. You're holding something that's critical to modern technology. You're holding something that's in a structural supply deficit. And you're holding something that's dramatically undervalued relative to its historical relationship with gold. But there's another aspect to this that's crucial. Silver is insurance against monetary instability. We're living in an era of unprecedented monetary experimentation. Central banks have expanded their balance sheets to levels that would have been unthinkable a generation ago. Governments are running deficits that can never be repaid through taxation alone. The only way out is through inflation, either overt or hidden through financial repression. What happens to your purchasing power when the currency loses value? If you're holding dollars or euros or any fiat currency, you're losing ground. But if you're holding silver, you're holding something with intrinsic value that tends to rise when currencies fall. It's not a perfect hedge, but it's one of the best options available to ordinary people. Here's something worth considering. Throughout history, silver has been the people's money. Gold was for kings and governments. Silver was what regular folks used for everyday transactions. There's a reason for that. Silver is more abundant than gold, making it more accessible. But it's still scarce enough to hold value. That accessibility is important because it means you don't need to be wealthy to protect yourself. 10 ounces is a meaningful amount. It's enough to represent real value, but it's not so much that it's out of reach for most people. Think of it as a foundation. You're not trying to get rich off 10 ounces of silver. You're establishing a position in a hard asset that has thousands of years of history as money and an irreplaceable role in modern industry. Let me share something about market psychology. Right now, most people aren't thinking about silver. It's not making headlines. It's not the hot investment everyone's talking about. And that's exactly when you want to be buying. The time to acquire assets is when they're overlooked and undervalued, not when they're popular and expensive. We saw this play out with gold in the early 2000s. Gold was trading around $250 an ounce, and nobody cared. Financial advisors were recommending zero allocation to gold. Then the financial crisis hit, and gold went on a decade-long bull run to over $1,900. The people who bought when nobody was paying attention made life-changing returns. The people who bought at the top in 2011 had to wait a decade just to break even. Silver is in a similar position now. It's off most people's radar. The mainstream financial media barely covers it. But the fundamentals are building toward something significant. The supply deficit is real. The industrial demand is real. The monetary instability is real. All the pieces are in place for a major move. Now, I want to address something important. If you're sitting on retirement accounts, there are ways to get exposure to physical precious metals within those accounts without triggering tax consequences. I put together a comprehensive guide on how gold IRAs work, and it covers silver as well. It explains the process, the rules, the custodians, everything you need to know. If you've got $100,000 or more in retirement savings, this is worth understanding. The guide is in the description. It's free, and it might be one of the most valuable resources you look at this year. But let's get back to the bigger picture. The world is changing in fundamental ways. The post-World War II monetary system, the Bretton Woods arrangement, and everything that came after, is showing serious cracks. Countries are increasingly settling trade in currencies other than the dollar. Central banks are diversifying their reserves. The BRICS nations are working on alternative payment systems. What does this mean for you? It means the dollar's role as the global reserve currency is being challenged in ways it hasn't been since it achieved that status. And when reserve currencies lose their privileged position, it's not a smooth, orderly process. There are winners and losers. The people holding hard assets tend to be the winners. The people holding paper promises tend to be the losers. Silver sits at this unique intersection. It's a monetary metal with a 5,000-year history. It's an industrial commodity that's absolutely essential to modern technology. It's in a supply deficit that's getting worse, not better. And it's trading at prices that are historically cheap relative to gold and relative to its cost of production. Think about the solar industry for a moment. Governments around the world have committed to massive expansions of solar capacity. The International Energy Agency projects that solar will become the largest source of electricity generation globally within the next couple of decades. Every single one of those solar panels requires silver. There's no viable substitute that matches silver's efficiency and durability. The same is true for electric vehicles. As the automotive industry transitions away from internal combustion engines, silver demand from this sector is set to explode. We're not talking about a marginal increase. We're talking about a fundamental shift in how much silver each vehicle requires. And this is happening at a time when global vehicle production is measured in tens of millions of units per year. Then there's 5G infrastructure. The rollout of 5G networks requires significantly more silver than previous generations of wireless technology. Each 5G base station uses more silver. The devices connecting to these networks use more silver. As this technology gets deployed globally, it represents another massive source of demand. Add it all up, and you have a situation where industrial demand alone could absorb all the silver being mined, leaving nothing for investment demand or monetary purposes. But investment demand isn't going away. If anything, it's likely to increase as more people wake up to the monetary instability we're facing. Here's a question worth pondering. What happens when industrial users start competing with investors for physical silver? Right now, there's enough supply to meet both needs. Barely. But we're one supply disruption away from a serious shortage. A major mine closure, a geopolitical event that disrupts shipping, a surge in investment demand. Any of these could tip the market into a crisis. And unlike gold, where there are massive above-ground stockpiles that could theoretically come to market, silver gets consumed. When it's used in electronics or solar panels, it's gone. It's not economically viable to recover it. That silver is effectively removed from the available supply forever. This is fundamentally different from gold, where almost every ounce ever mined still exists in some form. The implications are profound. We're depleting a finite resource that's critical to our technological civilization, and we're doing it at an accelerating rate. At some point, the market will have to reprice silver to reflect this reality. When that happens, the move will be swift and dramatic. Let me tell you about market structure. The silver market is relatively small compared to other commodity markets. The entire annual silver market is worth maybe $25 billion. That's tiny. Apple's market cap is over $3 trillion. The entire silver market is less than 1% of one company's valuation. What happens when even a small percentage of institutional money decides it wants exposure to silver? The market simply can't absorb that kind of buying without prices moving dramatically higher. We've seen this dynamic play out in other small markets. When institutional money floods into a market that's not equipped to handle it, prices can move in ways that seem irrational. But it's not irrational. It's simple supply and demand. If there are more buyers than sellers, and the available supply is limited, prices have to rise until equilibrium is restored. Now, think about the average person's financial situation. Most people have the majority of their wealth in paper assets, stocks, bonds, retirement accounts, bank deposits. All of these are claims on future cash flows, denominated in currency. What happens if that currency loses purchasing power? What happens if the stock market corrects? What happens if bond yields rise and bond prices fall? Most people would see their wealth evaporate. But if you have 10 ounces of silver sitting in a safe, that's real. It's tangible. It's not dependent on anyone's promise to pay. It's not subject to counterparty risk. It's just metal with intrinsic value that you physically possess. In a world of increasing financial complexity and risk, that simplicity is valuable. There's also a psychological aspect to owning physical silver. When you hold it in your hand, you feel the weight of it. You see the shine of it. It's real in a way that numbers on a screen aren't. That tangibility matters, especially during times of crisis when confidence in financial systems is shaken. People want something they can touch, something they know has value. History is full of examples of paper wealth disappearing overnight. The Weimar Republic, Zimbabwe, Venezuela, Argentina, the list goes on. In every case, people who held hard assets were able to preserve their wealth, while those holding paper saw it become worthless. Silver has survived every monetary crisis in human history. Fiat currencies have a 100% failure rate over time. Which would you rather bet on? But let's be clear about something. This isn't about getting rich quick. 10 ounces of silver isn't going to make you a millionaire. What it will do is provide a foundation of real wealth that can't be inflated away. It's insurance. You hope you never need it, but you're glad you have it when things go wrong. And things do go wrong. Financial crises happen with regularity. We had the dot-com crash, the 2008 financial crisis, the 2020 pandemic crash. Each time, people who were prepared, who had diversified into hard assets, came through better than those who were fully exposed to paper markets. The next crisis is coming. We don't know when, and we don't know what will trigger it, but it's coming. That's not pessimism. That's just understanding how financial systems work. Silver gives you optionality. If the monetary system remains stable, you have an industrial commodity that's in a structural supply deficit. If the monetary system becomes unstable, you have a monetary metal with thousands of years of history. Either way, you're positioned to benefit. That's a rare combination. Consider the mining sector for a moment. Silver miners are struggling at current prices. Many are barely profitable or operating at a loss. What happens when these companies can't afford to keep mining? Production drops. Supply tightens further. Prices have to rise to incentivize new production. But bringing new mines online takes years and requires massive capital investment. There's a lag between when prices rise and when new supply can come to market. This creates a situation where prices can overshoot dramatically to the upside. We saw this in 2011 when silver briefly touched $50 an ounce. That wasn't sustainable at the time because it was driven primarily by speculation. But imagine if we get to $50 driven by actual supply shortages and industrial demand. At that point, there's no telling how high it could go before equilibrium is restored. The smart money is already positioning for this. Large institutional investors have been quietly accumulating silver through ETFs and other vehicles. They understand the fundamentals. They see the supply deficit. They recognize the industrial demand drivers. They're not buying silver because they think it's going to go up 10%. They're buying because they think it could go up 100% or more. But here's the advantage you have over institutional investors. You can buy physical metal. You can take delivery. You can hold it yourself. Institutions can't do that easily. They're stuck with paper proxies, ETFs, futures contracts. When the squeeze comes, when people start demanding physical delivery, those paper positions might not be worth what people think they're worth. But if you're holding actual metal, you're fine. 10 ounces is a starting point. It's enough to be meaningful, but it's not so much that it represents a huge financial commitment. Think of it as the foundation of a precious metals position. You can always add more later, but getting that initial position established is important. It gets you in the game. It gives you exposure to what could be one of the best performing assets of the next decade. And here's something to consider. Silver is divisible in a way that gold isn't. If you own a 1-ounce gold coin worth $2,000, you can't easily use that for smaller transactions. But if you own 10 1-ounce silver coins, you have flexibility. You can use one coin if you need to and keep the rest. That practical utility matters, especially if we ever face a situation where the financial system is disrupted and people need to transact outside of traditional banking channels. The world is becoming increasingly uncertain. Geopolitical tensions are rising. Monetary policy is in uncharted territory. Debt levels are unsustainable. Supply chains are fragile. Any number of things could trigger a crisis that makes people question the value of paper assets. When that happens, and it will happen, the people who prepared will be glad they did. Silver represents preparation. It's not about fear or paranoia. It's about prudent risk management. It's about recognizing that the financial system we've built is complex and fragile, and having a backup plan makes sense. 10 ounces of silver is a backup plan that fits in a drawer. It's insurance you can hold in your hand. The opportunity we have right now won't last forever. Markets have a way of staying irrational longer than you'd expect, but they eventually correct. Silver is mispriced relative to its fundamentals. The supply deficit is real. The industrial demand is real. The monetary instability is real. At some point, the price will adjust to reflect these realities. The question is whether you'll have positioned yourself before that happens or after. 10 ounces of silver. It's not a fortune. It's not going to change your life by itself. But it's a stake in a hard asset with thousands of years of history and an irreplaceable role in modern technology. It's insurance against monetary instability. It's a bet on supply and demand fundamentals that are as bullish as they've ever been. And it's something you can acquire right now, while most people aren't paying attention, while prices are still suppressed, while the opportunity is still available. The choice is yours. You can wait and see what happens, hoping that everything works out fine. Or you can take a small, prudent step to protect yourself against scenarios that are becoming increasingly likely. 10 ounces of silver. That's all it takes to get started. That's all it takes to have insurance that can't be printed, can't be debased, and has intrinsic value that's been recognized for millennia. The time to act is when nobody's paying attention. The time to prepare is before the crisis, not during it. Silver is giving you that opportunity right now. The fundamentals have never been better. The price has never been more attractive relative to gold. The supply deficit has never been more severe. Everything is aligned for a major move. The only question is whether you'll be positioned for it.